Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 349 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the strong rebound for stocks in April, interest rate cycles, comparing the current environment to the late 90s, and an update on the U.S. debt. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Morning, Mark. We're in May.
Yeah. Kind of hard to believe we're almost halfway through the year. I feel like it was just New Year's, but time just seems to be going quicker and quicker these days.
It does. It does. The April showers are following us into May here.
They are, which is pretty frustrating. I was back in Rochester visiting some family last week, and it was even colder up there, waking up in the 30s, which I think got me sick again. So we're on this perpetual cycle of warm, cold, which isn't great.
Well, at least we got the market going in our favor.
Yeah, April was certainly sunny for stocks, so let's just get right to it.
Yeah.
We will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on May 5th. Mm-hmm. S&P 500 index is down up 0.7% for the month of May and up 6% for the year. The Dow Jones Industrial Average down 0.7% for the month and up 2.6% for the year. The Nasdaq Composite Index up 1.7% for the month and up 9% for the year. Russell 2000 Small Cap Index up 1.7% for the month and up almost 15% for the year. And the Vanguard All World ex-US Fund is up 0.4% for the month, up 10.5% for the year. 3-month Treasury rate at 3.69%, the 2-year at 3.93%, and the 10-year at 4.43%. So obviously, really, really strong month of April. I think the Nasdaq was up double digits in the month alone.
Yep.
So it was actually one of the quickest V-shaped recoveries that we've seen on record for, I think, stocks selling off approximately 10% at least from their all-time high. So went from looking very bleak to new all-time highs in a very short period of time.
Yeah, and the culprit is earnings. And it's interesting. We were talking about this on the podcast in March, and I was being a forecaster. I said, listen, we're going to get to the end of April. Earnings season is going to be around the corner. If those numbers are good, all of a sudden the focus is going to come back to reality. To the fundamentals that are underneath the surface. Guess what's happened? They're pretty darn good. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. This is a good segue. How about I go to big headlines and current events? Because there was a good piece I wanted to share if you're good with that, Mark.
Sure.
So this piece was from briefing.com, and the timestamp on this was May 1st for good measure. Q1 earnings season update. Blended Q1 earnings growth rate has blown past expectations, sitting at 27.2% growth year over year for Q1 through May 1st compared to Q1 of 2025. That's just phenomenal, by the way. According to FactSet, versus the expectation of growth of 12.5% on April 10th. Let's pause there. April 10th, market is expecting 12.5% earnings growth year over year for Q1. April 10th. May 1st, so far the numbers are up 27.2%. That's mind-blowing.
Yeah, it's insanity.
I'll continue. Over the same time period, the 12-month EPS, which stands for earnings per share for our newer listeners estimate, has surged to 343.51 from 333.56. This is what briefing.com page 1 had a good summary. Quote, it's worth repeating today that this is the trend, the earnings trend that has enabled the stock market to rally the way it has in the face of rising oil prices and the uncertainty of the Iran war. Granted, there is a potential earnings headwind looming the longer the Strait of Hormuz remains closed. Yet, market participants haven't found reason to fear that condition because it hasn't been rattled by all the earnings guidance narrative to this point. Moreover, the market remains resolute in its belief that the Iran war and the blockade will end without creating long-lasting damage to the global economy, end quote. And I think, why is the market thinking that's the case? It's a midterm election year. It would be political suicide to go into the fall and continuing to kind of have more of a hard line. And there's an official Trump visit to China next week on May 14th and 15th. You also have that looming. Your thoughts?
Yeah, I think it's I was going to say quite simple. I don't know if that's the right term or not, but I was writing our monthly market update newsletter for our clients yesterday, and obviously earnings have been better than expected. I think the market is getting back to focusing on what matters in the long term and what drives stock prices, which is earnings. So I think the market is looking at the next 6 to 12 months down the road. And the thing that briefing.com said about the strait being closed, potentially that could be a problem at a later date.
Yep.
In my opinion, the market would sniff that out. And if it was foreseeing a problem in the next 6 to 12 months, I don't think the market would be as strong as it is. So
well played.
I think maybe the media narrative is a little worse than the actual situation is with the strait. That's just my 2 cents. But I'm, you know me, I'm one of those guys that looks to the market to tell us what's going on. And I think it's signaling to us that, we're getting past this stormy weather, quote unquote, that we've been in for the first, 4 or 5 months of the year.
I couldn't have said it better.
So
I think that's a great summary. And then only other big headline that caught my eye, and this timestamp was May 1st as well, Mark. The ISM U.S. Manufacturing Index has been in expansionary territory for 4 straight months. Looking very different. I won't have Jenna put up this illustration. I'll just verbalize it. You're just seeing, a big pickup on the manufacturing front. And I think it's just some of the administration's tariff policies are starting to work the way they were intended.
Yeah. Okay.
I'll send it back to you.
Yeah. Moving on to tweets, articles, research from this week. First thing I had was a post on X from Ryan Dietrich on April 30th. He said this: the S&P 500 is having a huge April, up more than 9% right now. I just got to pause and chuckle when I read the word huge. Like I said, we traveled to Rochester last week, me and my older daughter, Mia, and she's obsessed with airplanes, right? So she was looking out the window and seeing other airplanes. She was like, Dad, that's a huge airplane.
That's awesome.
It's pretty cute. But anyways, back to Ryan. He said the S&P 500 is having a huge April, up more than 9% right now. 10 other times in history, it gained more than 5%. May was higher 9 of those times, and both the, quote, sell in May period, which is May through October, and the rest of the year were up substantially better than the average returns. And again, for our newer listeners, there is a Wall Street adage that is, sell in May and go away, saying that if you look throughout history, since the market's inception, typically the May through October period is the weaker half of the year, and the October through April period is the stronger part of the 12-month period, right?
Yep.
But this, tells a little bit of a different story when we have this strong of an April, and I know it's only been a handful of times where April has had a stronger than 5% return for the S&P 500, but if you look at the return the rest of the year, stocks are up on average 12.5%. and up 80% of the time. So
pause real quick. All these years, when I read down the years, in my head, these are all recovery years, by the way, which is very interesting to me. So just real quick, I sit there and I think about, 2001, 03, 09, 2020. These are all recovery years. 83 a recovery year. Very interesting.
Interesting. So is this, even though we were only down approximately 10% on the S&P. Is this getting treated as something that was larger than that?
I don't know. It feels like, I mean, the data set that matches it. These are majority all recovery years.
Right. Interesting. I didn't even catch that. So that's a great point.
That's interesting to me.
Next thing I had was a post on X from Terry Borgiat, and this was on April 27th. Kind of an interesting thing here, Matt, and I want to get your opinion on it. So
I haven't seen this yet.
Has a question about bubbles, right?
Oh, here we go.
So he says, what if the biggest bubble in our lifetime isn't crypto, not AI stocks, not real estate? What if it's the one asset every pension fund, every retiree, every, quote, safe portfolio is loaded with?
Treasuries?
Bonds. 200 years of rate cycles say the same thing. Every peak lasts 56 to 67 years. The 1981 top was at 14% yields. The 2020 bottom was at 0%. 39 years of falling rates just ended. What if we're now at the start of the next 50-year cycle upward? Most investors have never managed money in a rising rate world, which I agree with.
Oh, yeah.
The entire career has happened inside the bull. The unwind has barely started, and no one is talking about it. So I'm not trying to get all conspiracy on people, but I am open to the possibility that we could be in for a very different interest rate environment over the next 20 to 30 years. And I don't know how many people are prepared for that, because if you've been managing money for 2 decades, it's always been in a falling rate environment.
It's been easy peasy, baby. Buy a bond, rates go down.
So what happens if we are in this steadily rising rate environment? And, you know, the other thing that I saw related to this that I think I'm going to talk about next week a little bit is one of the ratios I was looking at with Nick yesterday is the TIP ETF, the Vanguard Treasury Inflation Protected Securities ETF, relative to just the nominal Treasury ETF, 7 to 10 year bond, which is ticker symbol IEF. And essentially what that shows you is inflation expectations. So if you have TIPS outperforming nominal treasuries, the bond market is expecting inflation to go up over the next 6 to 12 months and vice versa.
Correct.
And just very quickly, TIPS or Treasury Inflation Protected securities are securities bonds issued by the U.S. government that the principal moves up when inflation is rising, principal moves down when inflation is falling. So it's a way to protect some of your investment during higher inflationary environments, right?
Correct. It pays like no interest, but it pays you whatever the CPI is that year.
Right. And there's a lot more that goes into it when we talk about duration and the length of these bonds. I'm not going to get into that today. And it's funny because when the Fed started cutting rates, inflation expectations and rates in general started to rise. And typically that's not something that someone would expect. They're like, the Fed's cutting rates, but you know, the rates on the 10-year and the 30-year have been going up steadily. What is the reason there?
Yeah.
And I think people are still concerned that inflation isn't going away, or it's going to be more sticky, or we are just going to be in a higher rate environment going forward. Again, I'm not going to sit here and predict what's going to happen, but I thought it was an interesting case. And oh my goodness, if that is the case, you know, it's going to be interesting to see what happens to a lot of these pension funds. And I also think we've done a good job on this show talking about how bonds aren't necessarily safer versus stocks or real estate or commodities just because they're bonds. There's a lot more that goes into it because of that.
You're not wrong.
And if this is the case, I think people are going to get caught, you know, with their trousers down.
You're not wrong. I'll take it one step further. The perception as I own bonds, I can't lose a lot of money. You could lose double digits pretty quick in bonds.
Oh, yeah.
I saw some post. There was some tech companies. I think Alphabet was one of them, that a couple years ago when rates were low, issued some 50-year bonds. In the price on those bonds relative to when they were issued, I want to say they're down like 30% plus. 30% plus. And I just want to throw it out there. You make a really good point. You know, I'm a senior citizen in this industry, okay? And a lot of people just haven't managed money through these time periods. And you know, the problem is a lot of larger firms spout modern portfolio theory. And if you're shoving a lot of money in these asset classes and you're like, well, I know the outlook's not good, but modern portfolio theory says I need to allocate to it. Dangerous.
Yeah, let's get one thing straight. I think it's been talked about to a lot of people that bonds are your safe haven. They are going to guarantee you, and this is not me talking, this is others.
It's the stereotype.
Yeah, it's the stereotype. Bonds are going to give me X amount per year. And just like the stock market, the bond market doesn't owe anybody anything. And like you said, it's very, very possible, and we've seen it in the past, not too recent, or excuse me, in the recent past that, bonds can be down double digits. I mean, most bond ETFs, you look at any of them, you pull them up, they've been in a drawdown for 6-7 years.
You're not wrong
at this point.
You're not wrong. I love that you brought this up.
Yeah, so I thought it was an interesting piece. Obviously, this is something that would play out over a long period of time, but something to consider. So.
I have a complimentary piece when it's my turn in a minute.
Last thing I had was a post on X from Steve Deppe on April 28th. Steve is a CMT, chartered market technician. He said, here's a fun random stat that I've teased. Since 1960 or even 1950, when the S&P 500 closes the month of April at a new all-time high monthly close, the remainder of the calendar year's performance has never been negative. A perfect 17 for 17 average returns of 10.35%.
That's juicy.
Just another topic that I think to back up my first point that I made is there's something to the month of April with how the rest of the year plays out. So I think if you are someone who is a long-term stock investor, that these type of stats should give you some confidence going into the rest of the year.
I'm here for it.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
I'm going to change my order on purpose, given what you went over. So I am going to start with a piece on the Fed, okay? Friend of the podcast, Mike Zaccardi, had a post on May 1st, Mark. And Mike was talking about the Federal Reserve. Okay, so the Federal Reserve is our monetary institution that controls interest rates, also controls liquidity. And his post said, once Myron leaves, there will be no more doves per Bank of America. Now, the illustration that Mike was talking about will be in our show notes and all of our social media sites, the likes of LinkedIn, Facebook, X, etc.
And Myron is a person that's on the...
He's a Federal Reserve voting member.
Yeah.
So I'm going to kind of break down what is being talked about. And so follow me here for a second. This is my prepared notes. I want to break down this really interesting tweet I saw by Mike Zaccardi. He posted this from a Bank of America piece about the Federal Reserve. First, let's talk about what this means. The Federal Reserve, usually just called the Fed, is a big organization that controls interest rates in the U.S. Interest rates are basically the cost of borrowing money. When rates are low, it's cheaper to buy a house or start a business. When rates are high, borrowing costs are more, which can slow the economy down. Inside the Fed, the people who make these decisions don't all agree. They use two fun nicknames in the media that most people don't understand the difference between. They use the term doves and hawks. Imagine a dove, a peaceful bird that doesn't like fighting. A dovish person on the Fed wants interest rates to stay low and even go lower. Why? Because they think cheap borrowing helps create more jobs and keeps the economy growing strong. They're okay with a little more inflation, even if it means people have to work and businesses are doing well. Now picture a hawk, a sharp-eyed bird that hunts. A hawkish person on the Fed wants interest rates to stay high and go even higher. They're mostly worried about inflation when prices at the store keep going up. They believe higher rates cool things off, keep prices steady, and protect the value of money, even if it means the economy grows a little slower and some people might lose their jobs.
There's so much better vernacular, that they could have chosen than those two.
You and I should come up with it. We need to revamp this stuff. They've been talking about doves and hawks for decades.
Yeah, it's crazy.
The chart in this tweet shows where all the current Fed leaders stand on the line. Dove on the far left, hawk on the far right, and you have what we call your centrist, the middle of the road in the center. Right now, one guy named Stephen Marin is way over on the dove side. He really wants big rate cuts. But according to Bank of America analysis, he's leaving next January. Once he's gone, every remaining single voting member on the committee is either a centrist or a hawk. No more strong doves. Why should you care? If the Fed becomes less dovish, it probably means interest rates won't come down as fast or as much as some people hoped. That affects mortgage rates, car loans, credit cards, and even how fast your paycheck feels like it's growing. So that's the tweet in plain English. The Fed might be shifting from let's help the economy grow to let's make sure inflation doesn't come back. And I think this is important for me to hint because there's a lot of talk about the Trump administration's appointment of a new Fed chair. And I think there's some misinformation that this individual can just get into power and start unilaterally making decisions, which is not the case.
Right.
Any comments?
Yeah, I don't think it's been any secret. Trump's been pretty outspoken that he thinks rates should be lower. And so people assume that
he appoints someone, they're going to do it.
Right. So, and if you look at the makeup of the current, FOMC, it doesn't look like that's the case, right?
That's not the case.
And it's interesting. Yeah, it pairs well with what I said earlier with, the bond market right now is telling you that inflation is still a concern.
You think that was good? I'm going to add to it. Here we go. This is a post from Evan. Is it someone I track on X? Handle is at StockMKTNEWZ. Okay, stock market news is what that would stand for. It's a post about national debt rising here in the U.S. This is what the post said. The United States national debt just climbed to over 100% of GDP for the first time since World War II. The U.S. national debt currently sits at $31.265 trillion with a T, while GDP over the last year was sitting at 31.216. So we eclipsed it. So I became a detective, Mark. Did my own little research. Okay? So I'm going to put a couple things into perspective. We talked about our gross domestic product, the economic output of the U.S. in a given year, around $31 trillion. Our growth rate on an annualized basis, we're around the 3% range. Let's start comparing. The Eurozone, their GDP is around $19.5 trillion, and their growth rate's about 1% or so. So U.S. debt to GDP is 100%. Eurozone for a whole is around 88. I'll continue. Japan's GDP is 4.4 trillion. So a very minor portion of America. Their growth rate is 0.7%, and their debt to GDP is 230%. China's GDP, 21 trillion, if you're given some good measures. Growth rate around 4.5%. Debt to GDP around 100%, depending upon what source you quote. A little fuzzy there. India's GDP is around 4.15 trillion, and the growth rate there is 6.5%, and their GDP is in the low 80% range. So why am I bringing this up? The more debt these countries take on in comparison to their economic output puts more risk that the countries overextend themselves and won't be able to pay that money back. And so what's the usual playbook, the easy out for politicians to take? We'll just print the money to pay it back. And what's the problem with printing money, Mark?
Causes inflation.
2022 comes right back into play. Mm-hmm. So I just want to throw it out there that you are bringing up a great point about bonds. And you and I could go on a series of factors that could affect the pricing of bonds the next couple of decades. And the debt level's one of those. And for better or for worse, the current administration is taking the we're going to grow our way out of it approach. Will it work? I have no idea. But I think it's an interesting kind of approach to how they're going to tackle this. Okay. All right. My next piece has to do with a comparison. I'm getting my notes together of the late 90s versus today. Okay. And this was a post by Ren, and it's a trader that I follow on X. And he's showing a chart that he's referencing from Joseph Carlson, and it shows Google's cloud computing revenue. And the chart on this cloud revenue, it goes back, Mark, since 2020. And what it shows recently is kind of a parabolic move in their cloud revenue. This is not a recommendation for or against Alphabet, but you'll see where I'm going with this. This is what Ren said. Quote, to think people are expecting the bubble to pop like it did in the dot-com era, today's Mag 4 PE ratios, that's price to earnings, how much we're paying for earnings, Meta's at 16x, Alphabet's at 17x, Amazon at 24x, Microsoft at 25x. Dot-com bubble peak PE ratios back in the 90s, late 90s. Microsoft, 73 times, Cisco, 200 plus times earnings, Yahoo, 800 times earnings. The Nasdaq as a whole traded at a PE of 200 at the peak of the dot-com bubble. I'll say it again because I want to make sure the people in the back hear me. The Nasdaq as a whole traded at a PE of 200 at the peak of the dot-com bubble. Today's bubble is trading at 16 to 25 times earnings on companies generating hundreds of billions in free cash flow. I'll say that again. Hundreds of billions in free cash flow. Today, we have the most profitable companies on earth. Not a recommendation for or against these, what Ren's saying, but I want to name them, what he posted. Microsoft, Alphabet, Meta, Amazon reported beats on earnings, and you think we are in a bubble. My point is this. It is very dangerous to compare just because tech is doing very, very well compared to other industries, that in order for it to normalize, that we need to have a 50, 60, 70% correction in that sector. Is that possible? Mark, you and I both know very, very well. Of course it's possible, depending upon the global economy and what happens. But my point is, I think it's very dangerous to compare the late 90s to now when you look at the balance sheets, you look at the earnings, and don't even get me started on inflation and the value of the dollar and how we still think comparing a PE ratio of 30 years ago and what a dollar bought at that time to now. That's my point. Be careful with those analogies. There's been a lot of people pounding the table for 10 years plus that we're in a bubble in tech. We will have corrections. Some of those will be severe, but the comparison, it doesn't work for me. Your thoughts and comments?
Yeah, no, I agree. I didn't know that that Yahoo was trading at 800 times earnings. That's pretty insane now, considering that Yahoo, I think, is considered one of the worst email search functions out there now, which is kind of crazy. It just goes to show you how quickly things can change. But I really don't have anything to add. I think, if you look at this chart of Google's cloud revenue, I think you said it was.
Yes, sir.
It's pretty crazy.
I mean, just to throw out some numbers, Q3 2025, that's a stone's throw of how close that is in proximity. Their backlog, 150 billion. Then it went to Q4 and it went up to 240 billion. And they reported earnings in Q1, 400 billion.
Yeah, these companies, all of the ones that you just listed, they have business segments that could be their own publicly traded company that would still be one of the largest companies in the world. That's how nuts it is, right?
Yes. And my last thing is, just because these companies are doing well right now doesn't necessarily mean their stocks will.
Yeah.
I mean, the stocks could be well ahead of where their actual operating is, and the company could do well and the stock not. So I just want to be careful. And that's even not me even throwing the compliance hat on. That's just just temper it, but don't just assume just because tech's doing well that it's going to end like the 90s.
Yeah, stock success and business success don't always follow each other, one for one, essentially.
And I think we leave it with, in good Mark McEvely adage, invest for your risk tolerance, your time horizon. Don't get caught up in, the clickbait of the hour.
Yeah, I couldn't have said it better myself. So thanks everyone for listening to episode 349 of the Independent Advisors podcast. Catch us next week for episode 350.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.